In contemporary portfolio theory, investment strategy is most effectively understood not as a single prescription, but as a disciplined alignment between capital and purpose. The central premise of goals-based advice is that wealth acquires meaning only when it is organized around concrete objectives, whether those objectives concern retirement income, educational funding, home acquisition, liquidity preservation, or intergenerational transfer. The first analytical step is the classification of goals by time horizon, required certainty, and acceptable downside. Near-term obligations generally demand capital preservation and high liquidity, while long-term objectives can tolerate greater volatility in exchange for a higher expected return. This distinction is not merely technical. It protects the investor from applying an inappropriate level of risk to an essential future need. A portfolio intended for a child's tuition, for example, should not be managed under the same logic as a speculative allocation designed for long-run growth. Once goals are mapped, strategic asset allocation becomes a problem of prioritization. Rather than treating all assets as interchangeable units of return, the investor separates the portfolio into functional compartments. Conservative assets may be assigned to liabilities that are fixed and imminent. Growth-oriented assets may be reserved for aspirations with flexible timing and broader risk capacity. In this framework, diversification is not simply a rule for reducing variance. It is a mechanism for ensuring that one objective does not imperil another. The logic of rebalancing is equally important. Market movements inevitably alter the original relationship between risk and purpose. Periodic rebalancing restores the intended structure and prevents emotional responses to market fluctuations from dictating long-term decisions. An investor who silently allows successful speculative assets to dominate the plan may unintentionally convert a carefully designed strategy into an unstable one. Discipline, therefore, is not a passive virtue, but an active form of risk control. Behavioral considerations further strengthen the case for goals-based investing. Individuals rarely fail because financial models are unavailable. They fail because uncertainty induces inconsistent action. By linking each allocation to a specific objective, the advisor replaces abstract performance chasing with a more intelligible narrative of progress. The question changes from whether the portfolio has outperformed in a given quarter to whether it remains adequate to fund a defined future need. Ultimately, the most persuasive investment strategy is one that integrates quantitative analysis with human purpose. Goals-based advice recognizes that capital is not an end in itself. It is a means of converting present resources into future options, security, and autonomy. The success of a portfolio should therefore be measured not only by returns, but by its capacity to accomplish the purposes for which it was designed.